Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. We're talking about accretion dilution. This math, to be honest with you, I was not able to answer this interview question after 2 years of banking. It was not a type of analysis that I happened to spend time on. And when somebody explained to me how to think through this, I was like, oh my God, that makes so much sense. And it's so cool. So I'm super excited to teach this. We left off having introduced accretion dilution a little bit. And what the goal of that analysis is if you are a company trying to articulate shareholders why you're doing a particular thing, in this case, you're buying a company, one very reasonable question your shareholders might say is, look, our stock price goes up and down. You don't have perfect control over that, but you do control the earnings per share that I see on each of my shares of stock. If I own 100 shares of your stock and you were trading at, some value that equated to $2 per share of earnings every year, and you're telling me you're buying this company, I want to know, did my expected earnings per share this year go up or down? And that's where accretion dilution analysis comes in. Basically, the goal of accretion dilution is to say, directly as a consequence of acquiring this other company, will your earnings per share go up or down as a result of the acquisition? And the example we started off with last time was in a situation where the acquirer has a bunch of cash sitting on their balance sheet. They're not doing anything. It's just money. And they have a chance to use that money to buy this company. And we said that is going to be accretive 100 times out of 100, because when we're thinking about earnings per share is an income statement number, cash on the balance sheet is a balance sheet number. And if we're not investing that cash right now, then it's just sitting there. It's not affecting the income statement at all. And so when we use the cash to buy a company that has positive earnings, that is always going to be accretive, because we didn't touch our earnings and we bought these new earnings. So our old earnings plus the new earnings is greater than it was before. So accretive, great. Now I want to talk about kind of a funny case where we're doing an all stock acquisition. And we're saying that our company has a PE ratio of 20, which is to say, for every, if our stock is trading at $20 per share, having a PE ratio means that each share is generating $1 of earnings per share. PE stands for price divided by earnings. So if the price is 20 and our PE ratio is 20, then our P of 20 divided by our E equals 20. And so the denominator is 1. So for all of our shares out there, it's basically $20 of value for every $1 of earnings. And in an all stock sale, basically what you're doing is you're trading your company's stock for the other company's stock. And so a question you might ask is, if you're acquiring a company with a PE ratio of 15 and you're trading your stock for their stock, as a result of that swap, is your earnings per share going up or down? So I'm curious, how would you guys think about approaching that problem?
So if a company with a PE ratio of 20 is acquiring a company with a PE ratio of 15, I think it's accretive because they're paying less for each dollar of earnings than their own earnings are worth.
That is exactly the right intuition. And let's do some math to say how accretive or dilutive.
Okay.
So your intuition is spot on, which is to say your company's PE ratio is higher than theirs, which is a way of saying that your stock is more expensive than their stock. So what is some math, or how would you think about trying to quantify how accretive this would be.
Do we need any more like figures or data points, or
Amazingly, no. The first time I got asked this in an interview, I was like, well, I can like sort of think through it, but I feel like you need more information than this, but it turns out that you don't. This is all you need.
I don't know exactly how we would particularly go about calculating this, but couldn't you calculate the combined PE ratio after acquiring the company to give you more direction?
It's interestingly, we aren't going to try to estimate what the future PE ratio will be post-acquisition, because that's dependent on how the stock market reacts to the news. Like, we don't know how the PE ratio will change because we don't know for a fact how the stock price will change, which is to say we don't know how the PE component will change. Earnings per share is just the E in that. So we're only focused on the change to earnings. And the way that you can think about trying to do this conversion math is we traded a PE ratio of 20, right? So $20 of value per $1 of earnings. Just to make like for like numbers, saying it's $20 per $1 of earnings is equivalent to saying it's $60 of market value for every $3 of earnings. Right? So if we traded a PE of 20, then if we own 3 shares, then that's, $3 of earnings, assuming it was, $20 a share. We can do the same conversion with the target. So the target has a PE ratio of 15. That means for every $60 of equity value, they have $4 of underlying earnings. So basically, I just did like the 15 divided by 1. I multiplied the top and the bottom by 4. So 15 divided by 1 is the same as 60 divided by 4. And now we have even numbers where we can say if we're exchanging $60 of value in our company for $60 of value in the target, we are giving away $3 of our own earnings and bringing in $4 of their earnings. And so that, as a direct result of that swap, for every share that is getting traded, we're bringing in 33% of excess value. Now, I will say, if you wanted to know the to the penny EPS change for our company, I would have to know how big the companies are. Like, I would have to know that like both companies have the same market cap, for example, and then we could talk about, like the blended difference. But if you just want to know accretive or dilutive, I can tell you that we're giving away $3 for every $4 we're bringing in. And as a result, it's accretive. And so the takeaway here is that if you're doing an all stock acquisition, any deal where you're acquiring a company with a lower PE than yours is going to be accretive. So now what like a corollary is, or like let's do the flip side. So now let's flip our valuation. So now we have a P ratio of 15, target has a P ratio of 20. Accretive or dilutive?
Dilutive.
Yep, exactly. It's just the opposite. And do you think those deals happen? And if so, why?
I think they do happen, and it's probably because the company, like a company that acquires a target company predicts, like is thinking into the future, and they predict that in the future value might be different.
Exactly. That's exactly it, which is when we're talking about accretion or dilution, we're talking about the impact of our earnings per share in a particular year, and it's usually this current year. And so it doesn't take into account all of the future growth that you're doing. And so there are tons of examples of this. Basically, every biotech acquisition is dilutive because you're buying some thing that is costing you money for some number of years before it maybe hopefully produces some positive cash flow and some positive result. A lot of tech deals are dilutive. It's another common strategy of companies to buy growth. So like one example is like when Salesforce bought Slack, super dilutive deal for them. Like Slack was trading, I think maybe they were break even, but basically infinity PE ratio. And so if you're like, well, hey, this is dilutive, like why would you do this? The way you can, like, whether a deal is accretive or dilutive is one component of the acquisition story. And just because it is accretive or is dilutive, that doesn't mean like if it's accretive, you always do the deal. If it's dilutive, you never do the deal. Next accretion dilution examples, we talked about what happens if we just have cash sitting around and we use that to buy a company. We talked about an all equity transaction. Now let's talk about a debt funded acquisition. So same as the last scenario, our PE ratio is 15, their PE ratio is 20. And now we don't want to give away any of our equity for one reason or another, and we want to try to borrow money to buy them. What two pieces of information do you need that I haven't given you to be able to tell me if a debt-funded acquisition is accretive or dilutive?
Do we need to know like the interest rate on that debt?
Absolutely. Absolutely. Yep. And then there's one other thing we need to know, because interest is an expense that has a special property.
This isn't the tax shield, is it?
It is the tax shield. Absolutely. We need to know the cost of debt, like how much it would cost us to borrow that money, what interest we'd have to pay. And we need to know our marginal tax rate for this year, because every dollar of interest expense that we pay on this debt that we're borrowing to fund the acquisition, we can actually partially offset that because it's an expense. So it reduces our income and there's a tax shield that offsets that cost. So let's say we can borrow money at 8% interest. And let's say that our marginal tax rate is 25%. And I'll just do that quick math for everybody. If our pre-tax cost of debt, which is like the interest expense that we agree with the lender, is like 8%, and our marginal tax rate is 25%, that means that our after-tax cost of debt is only 6%. Basically, that is to say, like, our tax rate is 25%, and we can offset as a result a quarter of our interest expense with taxes that we don't owe because our expenses went up. So here we are. We know that our after-tax cost of debt is 6%. And I want to take that number over here and translate that to buying a target that I know has a PE ratio of 20. How can I think about making that conversion?
And sorry, what was the original company's PE ratio? Was that
Ours is 15.
okay?
But okay, so let me ask this question first. Does that matter?
Well, wouldn't it matter if our, I guess, PE ratio is less than the company we're trying to acquire's PE ratio in terms of if it's accretive or dilutive?
Is that true even if we're funding the acquisition entirely with debt? They're not getting any of our stock in this new example.
Oh, then no, it would only be if
Yeah.
Okay.
Our PE ratio is relevant if we're giving away stock as part of the deal. Like if it's a cash and stock deal, or like it's a combination of the two, then we care. But in this case, we're like the cost to us of making this acquisition is the after-tax interest expense. And the benefit to us of doing this is we get all their earnings. And so those are kind of like the two numbers I'm trying to compare. And so first, I'll take our 6% after-tax cost of debt. So recall we had our 8%, that's our interest rate that we agreed to with the lenders, but we have a 25% marginal tax rate, so we were able to offset some of that. So 6% after-tax cost of debt. In other words, for every dollar that we borrow to fund this acquisition, what is the negative impact to our net income? If our after-tax cost of debt is 6%, what is the profit loss for every dollar we borrow?
Is it 6 cents?
Yep, exactly. It's 6 cents. So for every dollar we're borrowing to fund this acquisition, we have this cost of 6 cents. So our EPS, our earnings per share, is reduced by, or sorry, I should say earnings per share. Our earnings is reduced by 6 cents for every dollar that we borrow. Now I want to do basically the same kind of like stoichiometry conversion that we did in the first example. Our target has a P ratio of 20. That means $20 of value for every $1 of earnings. And now I'm going to divide top and bottom, numerator and denominator, by 20 to basically say per $1 of consideration we give them, what are we receiving in earnings? And so what's that number?
$0.05.
Exactly. So if the target has a P ratio of 20, that means $20 of price for every dollar of earnings, which is the same way as saying $1 of market value for every 5 cents of earnings. So is this now, do we have what we need to say if this is accretive or dilutive?
Yeah.
And
Doing the mental math. So we said the company, the target company is, we converted that to $1 that we're paying to, or it's 1 over 5 cents. And then our company though is $1 over 6 cents, essentially. So
which is to say, yeah, we're for every dollar we're exchanging to buy all of their value, it costs us 6 cents for every dollar we give away. And we're getting 5 cents back in earnings for every dollar that we've given them.
So it'd be accretive.
So close.
Oh, I just totally mixed it around. Okay, it's dilutive.
Yeah, exactly. So we're losing 6 cents for 5 cents we're bringing in.
Right.
But that, like, your logic was perfect. It was just, you mix up those two at the end. But that's exactly the right logic. And by the way, when you're in interviews, this is why I can't stress enough the importance of walking through your thinking, because very often, like probably 8 times out of 10, you might know the right answer or how to get to the right answer, but you might have like an addition or subtraction flipped in your head, or you might have, and especially when the interview question is A or B, there's like, it only takes one flip to like give the wrong answer, but have the right logic. So highly recommend walking through your thinking exactly as you did. That is exactly the way to think about it, which is to say, you think like the way, the framework for thinking about accretion dilution is, what are you giving up and what are you getting back? And all of it is defined in the terms of like earnings per share. For every earnings per share increase I'm receiving from buying this target, there's some cost to me. Which is either, if it's debt, that cost to me is after-tax cost of debt. If I'm giving away equity, it is the EPS of my shares that I'm giving away. And you can use the same way to handle all types of complex scenarios where, you might be a $10 billion company buying a $1 billion company using a mix of balance sheet cash new debt and stock. And we won't go through that complicated example here, but you have all the tools to do that, which is basically just to say, if you're giving away 3 things, you can do each of those component parts and figure out the cost of each of those against the benefit of what you're acquiring. And that's exactly the math to do. Let me do one final example on this, because the way to crystallize this in your head is just to practice it, which is to say, same scenario we were just doing, same cost of debt, same borrowing for us. We did that math and we said, oh, it's dilutive. And in this hypothetical, our board or the board of the company that we as bankers are advising is saying, we aren't going to do this deal if it's dilutive. Like, our shareholders will be too mad at us. We think it makes sense, but like, whatever. So we're going to offer the target a lower purchase price. Like, we can't offer that, like, we debated offering them a purchase price that corresponds to a P ratio of 20. We can't offer them all that, but we want to at least give them something. So we want to come up with an implied PE ratio. Like, we want to offer some purchase price at a PE ratio that makes this all debt deal neither accretive nor dilutive, like, which is to say, break even from an EPS perspective or no impact to our earnings per share. How would you think about figuring out the break-even PE ratio at which acquiring this company using the same debt assumptions we were just using doesn't impact our EPS?
So the PE ratio for our company, when we broke it down, was, let's say, $1 over $6. And we need to convert like the implied PE ratio, the other company, so that those are essentially equal, right? So we need to change the market price per share so that those two are equal. So we just need to do some simple math.
Keep going. I'm with you so far. The first wording you use, the first verbiage you use, which is to say, we know half the equation, which is that we know, based on the cost of debt we just talked about, that for every dollar we borrow, it costs us 6 cents in earnings. And so to make this transaction break even or neutral for us, we know that for every dollar that we give away, we need to be receiving 6 cents. And so we need to offer a price to our target such that their PE ratio is whatever 1 divided by 6 cents is.
Right.
So that when we, recalculate that as a PE ratio, which is like dollars of market value per $1 of earnings per share, we need to know what that is. And that's 1 divided by 6 cents. And that 6 number cents, is like 16.6 repeating.
Right. Okay.
But yeah, so that's the math we would do, is basically like, we know what we're giving up is, 6 cents of EPS for every dollar we borrow, 6 cents of earnings for every dollar we borrow. So we need to get back 6 cents for every dollar we give.
Right.
And what is that in PE ratio land? Well, it's 1 divided by 6 cents. If you do that math on a calculator, it's 16.6 repeating.
Right.
And we already discussed some reasons why this is just one of the many ways of thinking about fair value, about thinking about M&A negotiation, about thinking about like at what price you'd want to buy this business. Because in the real world, you aren't able typically to acquire companies for whatever their like public market value is. Usually you have to pay a premium to wherever they're trading in the market to convince the shareholders to like give up their shares to you. Because if you offer the same as the market value or you offer less, they'll be like, well, why the heck would I do this? Like if I thought this was so compelling, I'd just sell my shares to this company and buy your shares, or like, I just like, you're not giving me anything to make me feel like I need to do this. That does it for today's episode. Thank you so much for listening, and remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.